You're listening to Counsel That Cares, a podcast series brought to you by Holland & Knight's Healthcare and Life Sciences team. With more than 400 attorneys practicing across the healthcare industry, members of our Healthcare and Life Sciences team are on the leading edge of industry developments. This series serves as your personal checkup on the multifaceted playing field of healthcare law and business trends.
Welcome to Counsel That Cares. This is Morgan Ribeiro, the host of the podcast and a director in Holland & Knight's healthcare practice. On today's episode, I am joined by my colleagues, David Marks and John Arnold, who are both partners in the firm's healthcare transactions practice, and Rahil Manji from ClareVest Group. In today's conversation, we are excited to discuss the current landscape of private equity in healthcare, and we'll explore key investment trends, ClareVest's unique partnership model, the benefits of a minority investment, and more on this episode. I'd love to provide our listeners just with a brief introduction to each of you. David, I'll start with you.
Thanks, Morgan. David Marks. I'm a healthcare private equity lawyer at Holland & Knight. 17 years of practicing law. It's hard to say, but is what it is. Proud member of the team at HK, along with John and a number of other close friends who are still ranked number one in the country in healthcare private equity deals closed. Recently awarded Private Equity Law Firm of the Year. My time is spent in healthcare services and the ecosystem that's around it. So that's really giving and receiving healthcare. So provider deals, doctors and dentists have been bread and butter for our team for many, many years, with an increased focus now in operational improvements. So things like AI tools, healthcare IT, as well as other areas besides the traditional provider plays where there can be real meaningful improvements, whether it's on the reimbursement side or just improving patient experience. So things like infusion, pharma services, and at the end of the day, across the entire spectrum of it, we're really helping clients get money, spend money, and make money.
Amazing. All right. John?
Thanks, Morgan. David, you did a great job explaining our practice. Mine is quite like yours. It's what I do day in, day out, with an emphasis on representing PE sponsors and their portfolio companies, but also in advising founders and others in connection with exits.
Great. And Rahil, ClareVest is known for its long-term collaborative approach with entrepreneurs. So can you tell us a little bit more about yourself and a little bit more about the firm?
Yeah, thanks, Morgan. So my name is Rahil. I'm a vice president at ClareVest. I've been at ClareVest for about 7 years and focus all my time in the healthcare services space. So a bit about ClareVest. So we were founded by a group of entrepreneurs who've been successful in their own ventures, and they wanted to help the next generation of entrepreneurs be successful. And that's how we started. We've been around for over 40 years with a really successful track record over that time. And we're currently investing out of our 7th fund, which is about 1.2 billion. But over that time, what's important here, I want to make clear, is that the philosophy has not changed. We remain solely focused on partnering with entrepreneurs and founders to help them scale their business. There's really 3 key differences between kind of how we approach private equity and I'd say most. The first big difference is we're very focused on strong alignment with founders and the management teams, which means more often than not, we're minority investors alongside the founders and the management team. The second big difference and related is that we are also very aligned. So 25 cents on every dollar that we invest comes from the team at ClareVest and the board. So we really think about it like it's our money first, and that we're very aligned personally with the founders of the businesses and the businesses we invest in. And then lastly, we're domain focused, which if you look on our website, we invest across a bunch of different industries as ClareVest, but I and my team spend all of our time in healthcare services. And we have 2 dental platform investments and 1 physical therapy platform investment, as well as over our history, we've been invested in home health, DME, home infusion, life sciences, et cetera. So that's a little bit about ClareVest.
Awesome. That's really helpful background as we head into this discussion. As we think about sort of larger trends right now, 2024 saw a surge in healthcare private equity. 2025 definitely presented new challenges, including just ongoing macroeconomic uncertainty and obviously regulatory changes at the federal and state level. John and David, could you give us a lay of the land on how liquidity pressure in particular, both to deploy and return capital, and public pressure are pushing healthcare private equity firms to rethink their approach on portfolio company economics and governance?
Well, Morgan, I think it's helpful to understand or situate where we are today in a broader historical trend. If you look at the first decade or so of private equity investment in healthcare, and even before that, when it wasn't private equity, especially in the PPM space, it was public companies in the 90s. And you see a lot of what really differentiated that time period is you had a focus and significant returns on due to arbitrage on multiples and financial engineering due to cheap debt. And what we saw in the last few years due to rate spikes was really a revelation. There were a lot of fractures in a lot of PPM roll-ups in particular that had not achieved real integration as they're going out and acquiring and building these companies. They had a lot of cheap debt dependencies when it came to CapEx and OpEx, where instead of being able to actually operationalize and achieve some of the stated reasons for doing the roll-ups, like better payer negotiation, achieving quote unquote synergies, right? That buzzword, but doing it in real ways where you can provide revenue cycle management improvement, accounting improvement, better just operating and financial controls. Instead, you have, people being cut, the need to manage your cost, and that coming at the expense of good business with some of these companies. In the meantime, the stigma with some of these businesses was making it harder for even the good ones to exit. As time goes on, and a lot of these companies have been held for quite a long time, or long in the tooth with a lot of these private equity firms, you had two pressures really coming into play. They seem like opposites, but it's just creating tension. So on the one hand, you have a lot of these healthcare private equity companies, especially in the PPM space, that are being long held by private equity funds that need to exit and not able to achieve a really adequate or ideal return, especially with the way that waterfalls and the capitalization was done for those early stage investments. And second is you've got a whole bunch of commitments, dry powder, where you have LPs who've committed to provide funding and their money is essentially tied up in short-term liquidity, high liquid securities so that they can provide money when called. But that money is not actually being deployed yet because there aren't as many good opportunities for new entry points. And the two factors together put a combination of massive pressure on the GPs to exit and achieve real distributions to their LPs, but also to take the money and actually invest it. And so you're seeing a combination of innovation in waterfall structures, in debt structures and strategies to deal with these rate increases, as well as new forms of deploying the capital, whether it's in co-investment, minority investment. It is forcing fundamentally a real focus across the board for GPs to spend their time and energy building up operational capabilities and proving that they can actually achieve real operational improvements. And I think that is the hallmark of what we're seeing on a go-forward basis in terms of what differentiates GPs from one another.
I agree, David. It creates somewhat of a cyclical issue where you have a limited buyer pool because buyers and lenders are taking more conservative approach to growth. There's leverage issues, and that just reduces the pool of financial buyers who are willing or able to recap platforms. Other platforms are simply too large for some financial buyers. And then you've got a limited seller pool because there are some assets out there that are not in the position to demand the multiples needed to generate the required returns, whether it's due to slower than anticipated growth or other factors.
Great. That's helpful, I think, to kind of understand the landscape and then where, of course, Clairvest fits into this. So first, Rahil, do you agree with the assessment that John and David have provided?
Yeah, I agree with it. What I would say generally from our perspective is we remain very excited about healthcare services. I think there are a lot of good opportunities to partner with good entrepreneurs and build strategically significant businesses in the space. At least from our perspective, we've obviously seen and heard of the same macroeconomic uncertainty and regulatory changes. Our view is, at least from a demand perspective, it's still stable in the long term, especially if you're kind of on the right side of healthcare and the trends, and as well as partnered with good people in the space.
I think that's right. On the regulatory front, what we have seen, I think, is stability over the last, say, 6 to 12 months. There's approximately 14 states today that have some sort of healthcare transaction reporting law on the books. These laws can vary from very short, simple pre-closing notices to extensive filings to state regulators who, have to approve the transaction before the parties can close. we monitor these laws and related developments on an almost daily basis, and we have a great navigator on our website as a one-stop resource for quick reference to kind of understand obligations and applicability and what's on the radar in other states, and that may be on the legislative agenda for this year. But that reflects a big uptick in new laws, new regulations that reacted in large part due to systematic issues in the healthcare system. And as a result of those, in many states, private equity became an easy target, I think, for regulators. Do they get everything right? No. But are they the problem? No. There's bigger issues at play. I think a lot of these laws reflect political agendas on the part of legislatures and attempting to say they got to win, say they did something about the problems that exist. But in the last 6 to 12 months, I think the number of new laws being proposed is starting to slow down. I think where there was going to be legislative action in many states, it has either happened or it has died. And we have a relatively stable framework in the majority of states, even in states that are traditionally more challenging from a regulatory perspective. The filing requirements in those states can be navigated. It extends your transaction by 30 days, perhaps. Is it going to create a significant issue for transacting in most states? No.
I totally agree. And there's something to be said for why is it the case that a lot of these, whether it's in the media or just within legislatures, there's so much focus on regulation. And I think it's not for regulatory sake. Maybe there's a little bit of that, but what's really going on is there's a lot of healthcare businesses out there that are not well run. And everybody knows that. Anybody who goes to the doctor has had experiences where there's lack of integration. If you ever are needed fertility services, there's a real lack of coordination between, women's health care on the one hand and urology for men on the other hand. And, even between the OB and the fertility specialists and the banks. That's just one example, but there are many, 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 and everybody's familiar with it. And in the background is this overwhelming demographic reality that people need these healthcare services. So what seems in some ways to be concern is really evidence that there's opportunity, because if you believe that there's opportunity for making the delivery of healthcare service better, which I think anybody in the United States who's ever received healthcare thinks that, right? When you go to the doctor, that's pretty much what everybody thinks. And if you're bullish on things like AI, right, one of the best use cases for AI is in provider spaces. So, there's a lot of opportunity here for that kind of operational improvement. But there's also, I think, a recognition that, that opportunity is because it's really not been enough of a focus. And I think it's pretty exciting to see what happens for the next 5 years.
So, Rahul, speaking of all these trends and the macroeconomic landscape and regulatory changes, do you find that those trends are leading entrepreneurs to have more interest in your model, that minority investment?
Yeah, so I think it's both of the trends in terms of the healthcare regulatory as well as just where kind of valuations have come are kind of leading to interesting trends, which is, I'd say overall, like while new deal flow has been slower than it was kind of in the 2021, 2023 period, high quality, good assets are still attracting good valuations and competitive processes. And kind of David's point on, like, there are really good, well-run businesses out there that are growing and that provide good care, et cetera. Some of the macro uncertainties, as well as some of the challenges with general partners and LPs and returning capital and dry powder, have driven more interest from entrepreneurs and more interest from GPs of doing minority and structured type deals instead of, full buyouts or full sales. Especially over the last 12 to 18 months, we've at least noticed a lot more of that. To be clear, we've been doing minority deals for 40 years. And so really our view is, like, it is just very important for entrepreneurs to think about and ask themselves, what are they looking for in a partner? Because there really is a lot more of an art to a minority deal, because it's not just about the dollars as it is in a full sale. And then the other thing I'd say just on this note is, like, when you look back at many of the deals that have happened in the space over the last kind of 5 years, there have been a lot of learnings, both I think from the entrepreneur and founder community, as well as the buyer community, that it's what providers are sometimes looking for in a deal. It doesn't always align with what a majority buyout provides. And I think that's just important to think about. The only other part I'd add to this is The type of entrepreneur kind of archetype that we look for, I actually don't think has changed much. Is you have strong entrepreneurs who built their business and who have a strong vision of where it wants to get to and just need a partner to help them get there that's done it before. Our entrepreneur partners are very focused on remaining in control and owning as much of the equity upside as possible. And it's not what we provide is not a very common model that's out there, regardless of, now or in the past. And the reasons are, for one, they're looking for capital to grow and do M&A. Number two, de-risking their personal life. So taking some chips off the table that allow them to then go and scale more aggressively and take that risk. Three, cleaning up messy or complicated shareholder structures that really align the cap table for future growth so that everyone's kind of aligned and rowing in the same boat. And then lastly, strengthening the balance sheet if needed.
Can you speak to post-close, what that looks like in terms of your involvement?
Yeah, so post-close for us in a minority position, what I like to say, that it is really true, is we are as involved as our partners want us to be. Many today, especially in that kind of with the different options of minority or structured investment out there are a lot of minority investments that are just very passive in nature. We don't do that. We can be very involved if our partners want to be. We can be hands off if they're doing something where they don't need our help. But for the entrepreneurs, it's really important, again, that they understand, who they will be working with post-close, what the cadence of meetings and communication looks like, and ultimately, where people will want to help or not, because there's a whole spectrum, and it's really critical to get deep into that before doing a minority deal.
Great. So kind of on the flip side, how does ClearVest partner-oriented approach influence your deal sourcing and value creation in the healthcare space?
Yeah. So ultimately, by taking a non-control minority position, we need to, and we are focused on aligning our interests directly with the founders and owners who are all in next to us. So we're sharing the risk and having a shared long-term view that allows us to be, as ClearVest, be thought partners to help them source transformative add-on acquisitions, recruit key talent, build a management team around them, and build operational competencies to scale the business. So this approach overall builds trust with them because we're helping them in the trenches with them, but it also ensures that we're working hand in hand with them to build a better, more strategically significant business versus just trying to financially engineer our way to a quick return, which has led to a lot of obviously negative situations in healthcare specifically. From a sourcing perspective, ultimately, like I've said a few times now, we're looking to partner with someone for the next 5 years. Relationship development is key. Obviously, while the terms and the transaction structure are important, it's also important to ensure that you and your partner have the same values and aligned vision for the long term. And for us, part of that means we immerse ourselves into industries that we believe will be long-term winners well in advance of when we do a deal. And so that looks like meeting multiple stakeholders, attending events, et cetera, so that A, we have a lot more conviction when we find something we like, and B, we can be better thought partners to entrepreneurs, again, because of the relationship in a minority angle.
Great. And you talked about this earlier about sort of why companies are typically interested in going with a minority investment. Can you talk about some of the key operational strategies that you're employing within your portfolio right now to drive that growth and efficiency?
Yeah, I would categorize it across call 4 buckets. So number one, with the management team. So we're partnered with the founder or the owner of the business typically, and we help them build an A+ team around them. So this is critical across finance, operations, revenue cycle, compliance, HR, marketing, et cetera. Number two, it's similar as on clinical operations. So a lot of times the providers, want to focus on clinical work. And so building systems and processes around them that allow them to focus on the clinical care and not worry about ever increasing administrative function and burdens of the healthcare system. We talked about it a little bit, but we're seeing already very significant efficiencies across documentation and coding using AI. Number three, on a similar vein, back office efficiency. So our view, and we've seen it, is that once you have the right data, technology, and systems in place, there are a lot of efficiencies to be had across all these administrative functions, both finance, RCM, and then as well as marketing and HR. And all of these things are obviously help our entrepreneur partners, but also help our businesses to really ultimately end up focusing on what's important, which is providers providing very good clinical care to patients. And then lastly, and I think ever more important today than in a long time, is having a very strong payer relations function, which a lot of our entrepreneurial companies don't necessarily have, and we've seen and can help them build.
Yeah, For sure. And we've definitely seen that as well with our clients. Access to talent and technology seem to be key differentiators. What advice do you have for healthcare entrepreneurs or management teams currently considering a private equity partnership?
Yeah, so I think overall, again, it's a big focus of ours, and we're seeing it more and more in deals. Is just like entrepreneurs are focused not only on the money, but like what values are shared with the partner, but also, how can you help? It's not just about capital, it's also about the relationship. I would also add on to that healthcare, and obviously you guys know this, but it's nuanced and complex. And so finding a partner who understands the healthcare landscape and can really help you navigate that at scale is obviously very valuable. And then lastly, for us, it always comes back down to alignment, a long-term alignment on values and vision. And that's something that we spend a lot of time on in our investment committee to make sure we understand and are aligned.
I would be curious in how your minority structure impacts the typical hold period and life cycle of the company as opposed to traditional private equity. One thing that we're seeing now, David, I'm going to speak for you because I'm sure you're seeing this now, but like just this week, I can think of at least 3 conversations I had about a new portfolio company or newish portfolio company, or on both sides, buy and sell side, where there's been a comment made about, we're having to think we may hold this company 6-7 years from now still, right? That used to just never be part of the discussion. I don't know what your guys' kind of timeline is and if that's something that is worth noting or talking about.
Yeah, I'm happy to talk about it. I mean, I think I like when we're a minority investor, while we will typically have a drag right after kind of 4 to 6 years, ultimately we're partnered with a management team who we're going to listen to them when it's the right time. Like if they've achieved all their objectives in 4 years, we're happy to go. If we're 5 years in and they see an ability to double or triple the business again in a few years, we're going to listen, trust them, and assuming, logical, and go with that. And then because we're the biggest LP in our own funds, we have more flexibility, and I'd say on average probably hold businesses a year to 2 longer than most. We have that ability, and we're fine doing it.
There is a point to be had that I haven't actually seen it that much yet. I had another fund raise the point to me yesterday that if, they go to market, there's just not the right fit for given the size, that they're like, look, we like the asset enough, we would just do a continuation vehicle. And, if you do that, then they're like, well, we would seriously explore getting minority investment in parallel.
Well, John and David, we discussed earlier the liquidity crisis. There are massive pain points around liquidity. And I know, Rahil, you've also discussed this a little bit, but can you talk about how minority investments are a way to respond to those pain points, David?
I'll start by saying that there's a very obvious play here, which is that minority investments allow for greater governance for whoever holds the rest of the equity, whether it's an existing controlling sponsor or founder. But in the context of increased cost of capital, what we're seeing are some changes in the waterfall, and we think these changes are here to stay as compared to maybe 5+ years ago. So one of the most significant differences is we're seeing a significant increase in the rise of participating preferred equity with the double dip feature, something like 12 to 15% returns on that. And that is partly a recognition that, okay, if you're going to do a minority investment, you're giving up the opportunity for control. And especially with the founder, you're making a bet on that founder and letting that founder be empowered and run a lot more. At the same time, it's structured to compensate the minority investor by saying, look, you're going to get more downside protection as well as a bit of a guaranteed minimum, which is important for fundraising purposes. One interesting thing that we're seeing is with these slices of equity is an increased ability to sell it in a secondary transaction without a tag right. Or maybe it's a more limited tag right, especially when it comes to healthcare providers, their ability to glom onto it. Historically, we might have seen something like a 20% forced rollover concept. We're seeing 50% these days. And sometimes for these minority slices, depending on the nature and sizing of it, there's a recognizability to say, hey, look, it's for everybody's benefit for that security to be more tradable than it was or would be if this were a controlled transaction. And, that allows for a lot more flexibility for the GPs as well to, if it is a GP controlled investment, to offer co-invest to some of their LPs in fundraising rounds. But even for founders, it allows them to get access to capital cheaper than debt right now. while still preserving governance control, but giving a reasonable return and protection to a minority investor.
Yeah, I think founders are also being asked to roll over more than they have been in the past. In part, I think that is due to buyers wanting to maintain higher valuations, even though the valuations have stabilized somewhat. So they will say, all right, we'll roll over more. And David, you were talking about CV deals and kind of partial sales to allow for liquidity, new equity to fuel growth. In connection with that, there are evolving terms and evolving market norms on things like tag rights. And what does that mean in a founder deal where the founder is rolling $50 million of equity? They could potentially be forced to roll at a recap. And are they forced to roll if it's a CV deal? Are they allowed to tag along with the CV deal? Things like that, which I think is playing out in real time. I don't know right now that there is a market for. I was talking shop with a partner at a management firm recently on how they are definitionally in their LP agreement or LLC agreement, how are they addressing this tag right issue?
And you and I have been raising this point for 2 years. And it's just shocking to me that there's so many folks out there who are completely convinced that they know what the norm is. And you might find two different people who are completely convinced and have completely opposite perspectives on what the norm is in terms of the right to participate in a CV transaction.
Right.
Especially if it's a GP-led.
Fundamentally, we've had disagreements with opposing counsel on exactly what constitutes a CV deal.
And that's one of those things that unless you have both good counsel and a good investment banker, if you're a founder, that's one of the most important terms that makes this different than how these deals have been done and the expectations for, if you have rollover equity, when are you going to see the cash on that? And that's one of the biggest differences now versus the last 20 years or the prior 20 years, because it might well be that you have to hold your equity for a lot longer. And I don't know that that's a bad thing. I mean, that might well be good for improving operations and incentives for good operations, but it's something that people have to really have a deep understanding of when they're choosing who are they going to, partner up with.
John, just to kind of close things out, I know we touched on this earlier about regulatory scrutiny and just the regulatory landscape right now. But in this current environment, sellers must really establish their credibility in terms of regulatory compliance, not only from sort of the scrutiny and headline risk for investors, but I think just establishing that confidence up front and the integrity of their revenue for valuation. So what do founders need to consider prior to even going to market as it relates to regulatory compliance and any differences in whether or not they are seeking a majority or minority investment?
Yeah, founders are often really growth focused and will get to a point where they start to realize, all right, now I need to bring in the compliance. And often when they are at that point, it's much more difficult and much more expensive to take care of that housekeeping and get their house in order from a compliance perspective. So it's much better to tackle that on the front end. Do you need a 100-page compliance manual with a compliance committee and a compliance officer if you're a small growing company? No, right? But what you do need are appropriate safeguards and protocols in place and a compliance program that is tailored to your business, the size of your business, and the resources that you have available. So it's always important to be thinking about those things on the front end rather than on the back end. When we see a compliance program or a bunch of compliance policies, procedures that have been put in place within 12 months of going to market, we don't give those much credibility. Great that you have them. What were you doing before? That's what we care about. On the antitrust front, it's also something to think about. Depending on the sector you're in, the size of your business, we have started to encourage clients to be thinking about keeping record and board minutes of having discussions about any antitrust issues if they are getting to a certain size in a market, to where it is part of the analysis, as part of what they're thinking about, so that they can come back and reference those if they ever needed to.
That's great. Well, I think that's an important note as we think about sort of these various structures that we've discussed on today's podcast and certainly where we're headed. I know we're heading up to the time here now, and I want to just, for some closing remarks, just to get everyone's thoughts here. Are we going to see more of the same from 2025, or what are your big predictions for 2026?
Well, I'll start with the bull case, which is that if if inflation stays tamed and the economy still improves, not just for the golden 7 companies like Nvidia, but really for the rest of the market, I think that you're going to see a real resurgence of interest and strong interest in valuations, even if it's not in traditional exits. We'll see a lot of these successful continuation vehicle deals with significant rollover by LPs and or just a lot of new entrants coming in and funding these. And I think a lot of that's going to be driven by, hopefully, a recognition that there are real opportunities for operational improvements, the likes that we haven't been focused on, but the industry as a whole and patients are desperate to see. So, if you're bullish on AI, I think I mentioned this before, but if you're bullish on AI, there's really not a better space out there than the provider space in terms of implementation of it and without having to pick a winner. Now, if inflation continues to rise and you see labor shortages, especially with some of the issues that we've seen in the other provider spaces like hygienists, for example, in the dental space, I think, again, it's going to increase the importance of a lot of the ecosystem around the provider space to deliver solutions, in terms of cost management. I think there will be even further focus on whether or not there's going to be revenue opportunities for revenue enhancement. And I think that a lot of the provider spaces and healthcare spaces that are dependent on consumer demand will get, questioned. So in the bull case, I think the areas like dental and med spa could be really, really interesting as reflections of just, retail healthcare. In the less bullish case, I think those areas might really meaningfully differentiate based on, platforms that have been able to successfully execute on a lot of the strategies and operational improvements and management improvements that, Raheel talked about that Clarivis focuses on. Those will really meaningfully differentiate. I think we'll see pretty significant spreads in valuation between the good and bad players in the market.
I was going to second that. I think that's exactly where I was going to go, is where you ended. I think there's going to be a lot of, at least my projection is that there's going to be a lot of really strong companies that focus on organic growth and recruiting, et cetera, over the last couple of years when many have struggled, that, will come to light, will come to market, and there'll be kind of a renewed optimism on like what's possible and what's been going really well in light of some, more challenging market. And then I agree. And I think we're seeing within our portfolio company is a lot of the AI discussion started early to mid last year, and some of the fruits of that are going to start being really evident in operations, et cetera, across provider businesses, in my opinion.
Raheel, David, I think you're both on point. I think in terms of deal volume going into the year, 2025 finished strong. We all have a lot of carryover deals that we're working to close in quarter one. So I think quarter one's going to be setting the pace for the rest of the year. I don't know that it will be a record-breaking year, but I think it will be steady and definitely busier than 2025 was, just in terms of deal volume. I expect to see more strategic transactions and consolidation, especially on the services side. In health tech, AI, biopharma, those are all going to continue to be hot, I think, for the obvious reasons. But I think the bigger transactions that we see this year will be happening on kind of a strategic deals.
Awesome. Well, thanks everyone for your time today. This has been a fun discussion, and look forward to talking soon.
Thank you for listening to Counsel That Cares. For more information on Holland & Knight's Healthcare and Life Sciences team, please visit hklaw.com/healthcare.